Hey there, welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about how to use annuities so that you can take more risk. Okay, so if you are retired, maybe close to retirement, but you still want to be in risk, you want to have a lot of growth, but you still want to have some protection, maybe you want some lifetime income, then listen up. I'm going to show you exactly how to do that with annuity contracts. So disclaimer, I make my money selling annuities, okay? I'll be totally transparent. But what makes me different is I show everything that's available. Okay, there's a lot of guys trying to sell these things and they want to make as much commissions as possible, and I get it. But it's important to show everything that's available so that people can make the best decision for themselves. And then if they want to work with you, they can reach out to you then. So feel free to go to my website, johnstevenson.com. You will see my annuity calculators. You'll be able to run the numbers yourself and decide what's best for you. But I want to show you how to use an annuity so that you can take more risk, because I love risk and I think I'm probably going to enjoy it for the rest of my life. You know, I'm young now, but when I'm in my 60s and 70s, I think I still want to be in risk. I would like to still have some risk from the stock market. I want some growth. Maybe I want to do some private placements. Maybe I want to do some startups. Okay. Maybe I want to invest into some high yield dividends, maybe a little bit higher risk. Okay. It would be nice to be able to have a higher return and have the risk and not be stressed out about it. Okay. Annuities can do that for you. And I'm going to show you how to do this, how to grow your wealth. Okay. And at the same time, be able to have a significant benefit from annuity contracts. So a lot of people will argue against annuities and they're like, well, annuities are terrible, right? They have horrible growth and all these fees and everything like that. Well, it depends on what you're looking for. Yes, some of them can be bad. But if you're looking for some contractual guaranteed income, or maybe just market risk protection, but you want some growth out of that, you can do that too. I mean, you've got indexed annuities that have no fees, okay? And they will give you half of the market, and they're pretty good. But this video is about increasing your risk. We want risk, and we want to use annuities so that you can have more risk. So I'm going to, really what I want to primarily look at is income. Okay, I'm going to look at income from an income rider, and I want to get as much of that as possible. And then at the same time, I want as much market growth as possible. So I want to be risky in stocks. I might want to put all of it in the S&P 500, or maybe I want to buy some Tesla or SpaceX, whatever. Okay. I want to buy things that are volatile, but I don't want to have to worry about it. Okay. I want to be able to grow my wealth, but I don't want to have to worry about when the market does drop, because it will. It's not a matter of if, it's when, right? And how many times, right? We don't want to deal with sequence of returns risk. That's an issue, especially when it comes to income. You might have $10 million and you're thinking, man, I'd like to have some growth, but I want to enjoy some of this for once. I'm going to have some income and have a lot of income, okay? So I'm going to just show my screen and I'm going to play with these numbers with you. Okay, so I've just pulled someone out here. They're 62 years old. They've got, they live in North Dakota, and they've got 1.5 million that they want to put into an annuity contract. So for this scenario, I'm going to say they have $3 million total net worth, liquid net worth. This is not including the value of their home. Okay, any assets that are illiquid. We're looking at, stocks, bonds, mutual funds, and brokerage accounts, and cash. Maybe you got 401k, IRA money. Okay, that's what we're looking at. So just total liquid. And so they got $3 million, but they're like, I'm going to take half of it because I want income. I want to enjoy my money, but at the same time, I want growth, but I also want cash on the side. So we'll talk about that. So we'll say $1.5 million, and we want to start it tomorrow. Okay, we want income coming in immediately. So looking at that, all right, so we're going to get $110,000, and you can see Meritage, Symetra, Prudential, they're all there. So it just depends on which carrier you want to work with. But I mean, if it was me, I would say, any of these three top options are good, but if I can get the same income pretty close with an A+, then I will. So Prudential is it. So I'm going to do that. And by the way, they'll pay me less commissions if you buy this versus these other ones. Okay, I can make more with these other ones. But again, that's why I show everything. Okay, I want you to see everything that's available so you can make the best decision for yourself. And I'll still push you towards something I think is better for you, not necessarily for my pocketbook. Yeah, I'd love to make high commissions, but it all evens out. Okay, so it's important. So we'll look at this and say, all right, so you're getting roughly 110, pretty close with Prudential. Okay, so you do that, then great. You've got lifetime income. I'll show you what that looks like, and then I'm going to show you what to do with the rest of your money, at least what I would do. Okay. All right. So with Prudential, we've got $1 million going in there. If there is no growth, let's say the market is just terrible because they're giving you some of the S&P 500. They're not giving you all of it. This is an income product, not a growth product, okay? You're turning some of your money into what you wanted it to be in the first place, income for the rest of your life. So based off of that, that is going to last till you're, 74, 75 years old, okay? That's based off of no growth. That is an extreme example, and that's probably never going to happen. So then you can see what it looks like with average growth. It's going to last a little bit longer, like to 77, 78. See, not even a huge difference. But the income is why you bought it. So you bought this for a pension, and if that pension pays you to 95, you've taken out $3.7 million. Yes, I already know $1.5 million can grow a lot bigger than that throughout your lifetime. I get it. But what are you going to do? Just grow it for someone else? Or are you going to enjoy it? Okay? Think about the years that you spent accumulating that $1.5 million. Okay? Maybe that represents 6, 7, 8, 9, 10 years of your life of just income. Okay. And did you work those years for someone else? Basically you took 8, 9, 10 years off of your retirement, just to work, just to leave it somewhere else. Okay. I'm an advocate for spending and enjoying it and also helping your family while you're alive instead of waiting till you're dead to leave them a lump sum. You can do both with this strategy though, because again, that's what this video is about. It's about using annuities so you can increase your risk. So let's increase our risk. Okay. We've already got our income covered. Great. Got $109,000. And maybe you don't want to retire at 62. You might be thinking, well, I want as much income at 65 as possible. That's where we're starting. We're starting our Medicare. We're going to retire at that point. Fine. Okay. We can do $1.5 million and it's $145,000. Okay. That's pretty good. Absolutely. Great payout. So we'll look at that and say, okay, we're getting that for the rest of our life, but we still want to be in the market. So let's be in the market. All right. So I pulled up an investment calculator here, and here's what I'm going to do. I'm going to say my starting amount is $1 million. Okay. Because remember, we've got $3 million. We put $1.5 million into annuity contracts. Okay. But we also want to keep $500,000 in cash. We just want cash in the bank. Okay. We want it for emergencies. We want it for liquid. That's what we want. Okay. We probably won't have to touch much of it. Maybe we'll stick it in a high yield savings. Okay. That's still nice. That cash will continue to accumulate little by little, but at least it'll be our cushion. Okay. So, but our $1 million outside of that, because we got $1.5 million after buying the annuity, our $1 million, we want to put it in the market. And let's say it's just the S&P 500. That's it. Okay. We'll say 7 years return rate on average with the S&P 500 is at least 10%. So if we look at that, no additional contributions, what does that look like? Okay, it almost doubles. Okay, the rule of, right, every 7 years it doubles. Okay, the same thing. So when this grows with just the regular stock market, average annual returns, if you average it over 100 years, that's what it'll do. So look, we already got $2 million. Okay, what if this grows for 10 years? 2.6 almost. Okay. And then let's say 13 years. 3.4. Look at that. 13. Let's go back to 12. I want to get right to the 3 million. I want to get back to that 3 million. Okay, 12 years is good enough. So in 12 years, your $1 million is right back up to where it was when you retired. 3.1 million. It's over it. Okay? And you still got the 500,000 in cash. Okay? And all because you got to take more risk. Pretty good. But what if you're like, well, 10%, yeah, I'm not going to be in the S&P 500. I want risk, John. Okay, I'm going to do some startups. Okay, some of them will fail, some of them will win, but over time, I'm going to average more. I'm going to average 15%. Okay. Well, it's now at $5.3 million. Now at that point, you might be thinking, well, that's a lot of money. I think I'll just take another 1.3 million out of that. I'll leave 4 million there, and I'll just buy another annuity contract. I'll buy myself another $120,000 in income just because. Okay. And you could just keep doing that. So a lot of people will do that. They'll let their investments ride. They'll be risky. They'll grow. And when the market drops for 2 or 3 years, they're like, fine, great, please drop. Because if it drops hard, then people will come in even more hungry and they'll want to buy it up more and it'll push it up even more. It always works that way. And you're not going to worry about it so much because when those down years are down, you're like, well, yeah, my portfolio over here is down, but I still got my $500,000 cash over here, and I've got my annuities. They're paying me. I'm getting $140,000 a year, and I've got my Social Security paying out another $40,000, so I'm getting like $180,000 a year. I'm good, right? My investments over here are growing, and I got a down year now, but I'm fine. It's nice because annuities allow you to be risky, okay? They allow you to be risky, okay? It's just important to know. So if I let this sit and grow, let's say I just don't even touch it. Let's say I just let it grow for 20 years, okay? I'm taking income at 65, and by the time 85 rolls around, my $1 million has grown to $16 million. That's really good, okay? Maybe you need long-term care. Great. Spend $6 million of it on long-term care if that's what you need. Okay, you still got $10 million to leave behind if you want to leave it behind. Or maybe you want to spend it. Maybe you want to spend, whatever. So it's nice because an annuity contract allows you to do that. Okay, it allows you to be able to put money in risk and earn and be able to enjoy the market returns and not miss out. And at the same time, be able to mentally and emotionally do it and handle it, especially when the years are down. We all say we can handle it, but when the market is down, we all want to get out. We all want to sell. We're all just looking for other opportunities, and we don't want to lose money, and we just make stupid decisions, okay? Annuities allow you to be a smart investor. They allow you to not make dumb decisions. They allow you to think rationally and think, well, I've got income coming in. I feel like I used to feel when I was 30 and I was working and I was investing. When the market went down, it didn't matter because I was working and I kept on having regular income coming in, so I was fine, right? It gives you the same feeling, okay? That's why it's important. When you're looking at annuities, they are pensions, okay? You got Social Security. Social Security is an annuity, okay? Pensions are annuities, okay? But what you're doing is you're buying another pension for you so that it allows you to be a better investor, risk more if you so choose, and be able to grow your wealth in better ways, okay? And very wealthy people have done this. I've had people worth millions and millions of dollars buy annuities for this very reason, okay? They want the contractual guarantees. They want their base income, and sometimes they'll ladder it out and they'll buy multiple contracts and they'll activate those at different times, and then they'll let the rest of their money sit in the market and grow. They'll grow their wealth, and this allows them to do it and still live comfortably. And they're smart in both ways. They can build their wealth and they've got their guaranteed income. I mean, Shaquille O'Neal did it. Okay, you got Babe Ruth who did it. Okay, you've got people who are worth hundreds of millions of dollars that still see value in these contracts. They're not listening to some of these gurus online that are saying, don't buy annuities, they're so horrible and the growth is so bad. Yeah, you're not even comparing it right. You're comparing apples to oranges, okay? You're not buying it for growth. You're buying it for the contract, the end. That's why you're buying it. That is value in and of itself. That allows you to invest your other money the way you need to, okay? That's what's important. A lot of these guys, they're just motivated by, hey, you got to buy mutual funds. You got to do this and buy it with us. And we're going to get, all these fees, assets under management. That's how we make our money. And everyone has a motivation. And then you got someone like me, buy annuities. I'll make a commission, right? We all have an agenda. We all want to make money, right? The purpose of this video is just to show you a way that you can build wealth and at the same time have the contractual guarantee that an annuity contract will give you, and so that you can enjoy a portion of your assets. What it's meant for is for income. Okay, yes, I'll make money if I sell you an annuity. Yes, I do. I would love for you to schedule a call. There's a link below this video. You can schedule a call with me. If you're looking for help to buy an annuity, I'd love to help you. But I always tell people, go to my site, go to johnstevenson.com, check out the calculators for yourself, play with the numbers, and then if it feels like, hey, this is something I want for my portfolio, then yeah, book a call with me. There's a link on my website there as well. So I'm not going to try to hard sell you anything, but I will show you everything that's available. And of course, I'd love to help you if that's what you're looking for. So anyways, I really appreciate you watching. I hope this video is helpful. I do. I hope that you're finding value from my channel. Absolutely go through the rest of my videos. There's so much there. And I try to answer questions all the time. I'm usually just always looking for ways to answer questions that people are trying to get answers to. And a lot of times they're getting answers from advisors who aren't giving them the right answers, or who are motivated by making money in a certain way, and they just won't give them the answer that they need or that's in their best interests. And so this is what this channel is all about. It's about giving you as much information as you can, and then you can make the best decision for yourself. So if you like the video, make sure you click the like button, subscribe, share, comment below if you have questions. I am happy to help, and we'll see you next time.